Markets don't move in straight lines, they shift in phases, and the most important changes are rarely visible in the headlines until after they've happened. What looks like a sudden turn is almost always the result of long building forces converging quietly in the background. That's what we're seeing now with silver. For years, it has existed in a strange space too small to command the attention that gold does, yet too strategically important to be ignored by those who understand the mechanics of global production, currency shifts, and industrial demand. We are now entering a moment where the structure beneath this market is about to change. The supply side, which many assumed was stable, is under pressure from declining mine output in key producing countries, tighter environmental regulations, and the rising cost of extraction. Above ground inventories, which have acted as a cushion, are thinning. These are not temporary disturbances. They are structural constraints that, once in place, tend to last for years. Foundation changes. The entire pricing mechanism must recalibrate. At the same time, demand is shifting in ways that are both predictable and underestimated. On one side, you have the monetary demand driven by investors seeking protection from currency debasement, political uncertainty, and persistent inflation. On the other, you have industrial demand that is accelerating as the world transitions to electrification, renewable energy, and advanced electronics, all of which rely on silver's unique conductive properties. These two demand streams are not competing, they are compounding. Historically, that kind of overlap creates tightness in a market far faster than most participants expect. Now, layer on top the macroeconomic backdrop. The global financial system is deep into a phase where debt burdens are high, real yields are unstable, and trust in fiat currencies is fragile. This is not an environment that rewards complacency. It is an environment where real assets, especially those with both financial and industrial utility, tend to rip. That's the context in which December 14, 2025 becomes important. It's not the date itself that holds magic. It's what the date represents. The moment when existing trends meet a catalyst big enough to force recognition across the market. Recognition is a key concept here. Markets can ignore reality for a long time, but when the collective awareness shifts, it happens fast. Liquidity floods and volatility spikes in positions that were manageable in a quiet market become untenable. This is when you see outsized moves. Not because the fundamentals suddenly changed, but because the crowd finally saw what a few had been preparing for all along. In silver's case, the structural pressures had been building quietly. What changes on a date like this is the collective narrative. Once that narrative shifts, you get what I call a feedback loop. Prices rise, drawing in speculative interest, which drives prices further, which in turn brings in more participants who have been waiting on the sidelines. The challenge in these moments is to separate signal from noise. Many will enter late, driven by fear of missing out, and expose themselves to sharp corrections. When momentum cools, the disciplined player is the one who understands the underlying structure, who sees this not as a short-term play, but as part of a longer cycle. Structural shifts don't just create opportunity, they also expose fragility. When you see a market tightening, you have to ask who is short, who is over-leveraged, and who is relying on cheap supply that may no longer exist. In silver, the leverage is not just in financial products. It's embedded in manufacturing contracts, in just-in-time delivery systems, and in the assumptions of industries that have treated silver as cheap and abundant for decades. When those assumptions break, the scramble for supply becomes real, and it does not resolve quickly. This is why understanding the structure is more important than predicting the exact price on any given day. You're not betting on a number, you're positioning for a change in the system itself. Once you grasp that, you realize that the real opportunity lies in being early enough to own something scarce before it becomes obviously scarce. It requires patience, discipline, and a willingness to act before the crowd sees what you see. So as we approach this moment, the key is not to get caught up in the hype of a single date, but to recognize the forces converging around it. August 4 will be remembered not because it creates the shift, but because it marks the point where the shift becomes undeniable. And in markets, that is often the most valuable point of all, when what was invisible becomes visible, and the structure you've been tracking quietly for years finally demands everyone's attention. When you look at markets through the lens of history, you see that the biggest moves almost never come from a single cause. They come from the convergence of multiple forces, each powerful on its own, but transformative when they meet at the same point in time. That's where silver stands today. It's not one headline, one policy change, or one economic report that matters. It's the intersection of long-term structural forces, short-term catalysts, and shifting investor psychology. On the monetary side, we are still in the late stage of a debt cycle. Governments across the world have accumulated extraordinary levels of debt, and central banks are trapped between fighting inflation and keeping their economies afloat. Interest rates have risen, but not enough to bring debt down in real terms. In that kind of environment, currencies lose purchasing power over time. Even if official inflation numbers appear under control, investors, especially those who think in decades rather than months, look for assets that are not liabilities of someone else that cannot be printed into existence. Silver fits that requirement. And unlike gold, it has a much smaller market, which means any shift in demand hits prices harder. On the industrial side, the demand profile for silver is undergoing a transformation. Decades ago, photography was the main driver. Then it faded, and many assumed silver's industrial role had peaked. But the rise of solar technology, electric vehicles, advanced electronics, and medical applications has reversed that trend. Every solar panel, every EV battery, every high-efficiency electronic component draws on silver's conductivity. And these industries not niche. They are central to the global energy transition, supported by both public policy and private capital. That means their demand is sticky. It won't disappear just because the price moves up. Then there's the geopolitical dimension. In a world where trade alliances are shifting, where resource nationalism is rising, and where supply chains are becoming more fragmented, the security of supply matters as much as the price. Countries that produce silver are reevaluating export policies, prioritizing domestic industries, and in some cases restricting foreign access. This isn't a short-term disruption. It's part of a global shift toward economic self-pay protection that add another layer of tension to a market that is already tight. These macro trends, monetary, industrial, and geopolitical, are moving toward the same point. Each on its own would be enough to put upward pressure on silver prices. Together, they create a scenario where the market's equilibrium is likely to break. When that happens, adjustment is rarely gentle. It tends to come with volatility, with sharp moves, and with a rapid repricing as the market incorporates realities it had been ignoring. There's also a psychological element to this convergence. For years, silver has been treated as the less glamorous cousin of gold, more volatile, less reliable, and lacking the same cultural and institutional backing. But market psychology changes when performance shifts. If silver starts to outperform gold meaningfully, it will attract speculative interest, which amplifies the move. This is the human layer of the macro puzzle. When people start to believe that something will go up, they act in ways that help it go up, at least for a time. The challenge for anyone watching these trends is that convergence points are easy to see in hindsight and hard to pinpoint in advance. The signals are there, the data on mine output, investment flows into solar and EVs, the debt levels, the currency pressures, but the exact moment when they all become market moving is not obvious until it happens. That's why the most successful players don't wait for the crowd's confirmation. They identify the convergence early, position accordingly, and have the patience to let this play out. When trends converge, they tend to reinforce each other. A supply shortage pushes prices up. Higher prices attract investment. Investment creates speculative demand, and speculative demand tightens the market further. In silver, because of its small size relative to other asset classes, these loops can be intense. Same dynamics that can push prices higher can also pull them down sharply if conditions change. But in the early stages of convergence, the momentum often runs in one direction as we look toward the coming months. It's not about predicting an exact price or timing a perfect entry. It's about recognizing that the alignment of monetary policy, industrial demand, and geopolitical realities is creating a pressure point. When enough weight builds at a single point, something has to give that moment of release. When markets rip rap rapidly, and for those prepared, it's when the opportunity is greatest. Silver story right now is not just about metal, it's about the collision of trends that have been years in the making. When those collisions happen, the results are rarely incremental, they are transformative. And once the market adjusts to the new reality, it never goes back to the way it was before. Every meaningful opportunity in markets carries with it a proportional amount of risk. The two are inseparable, like opposite sides of the same coin. Those who try to pursue one without the other often end up with neither. Silver today is a clear example of this dynamic. Its potential is undeniable, but so is the volatility that comes with it. The key is not to run from that volatility, but to understand it, manage it, and position yourself so that the upside outweighs the downside over time. The opportunity lies in the unique setup of the market. Silver is sitting at the crossroads of tightening supply, rising demand, and shifting macroeconomic conditions. On paper, that's exactly the kind of environment that can produce outsized moves. Historically, when markets like this break from equilibrium, the rising is not gradual, it's sudden and often extreme. In a small market like silver, even relatively modest changes in demand or supply can create significant price swings. For the investor who understands this, there is a chance to participate in a move that could be one of the more notable asset revaluations of this decade. But opportunity without discipline is just speculation. Silver's volatility is not theoretical. It's proven the same leverage that makes it possible for the price to move sharply in your favor can move just as sharply against you. In past cycles, we've seen silver rise by double digits in a matter of weeks, only to give back most of those gains just as quickly. The emotional highs and lows, those moves can pull people into poor decisions, chasing when prices are already stretched, selling in panic when they pull back. That's why having a clear framework before you enter is critical. Managing risk in this environment means starting with your time horizon. If you're looking at silver as a short-term trade, you have to accept that your entry and exit timing must be precise, and precision in volatile markets is difficult. If you're looking at it as part of a long-term allocation, your focus shifts to position sizing and diversification. The idea is not to bet everything on a single outcome, but to hold enough that a favorable move matters while limiting the damage if you're wrong. Another part of balancing risk and opportunity is understanding the catalyst and the noise. Markets are full of stories, rumors, and predictions. Some of them will prove to be accurate. Most will not. The disciplined approach is to focus on the drivers that actually move the market over time. Production trends, inventory levels, industrial demand, growth, and macroeconomic policy shifts. By filtering out the rest, you reduce the chances of making impulsive decisions based on short-term sentiment. There's also the question of liquidity in major assets like gold or large-cap equities. You can move in and out with relative ease. Silver, especially in physical form or certain derivative markets, can be less liquid when volatility spikes. That means your ability to adjust quickly may be limited. So you need to think about that before you put capital at risk. This is part of why professional money managers plan their positions around worst-case scenarios, not just the best-case outcomes. The opportunity is magnified when you think in terms of asymmetry, where the potential reward is multiple times greater than the potential loss in silver. That asymmetry exists right now because the price still reflects years of underperformance and underestimation. If the market prices to reflect current realities, let alone future demand growth, the upside could be substantial relative to the downside from current levels, but that asymmetry only benefits you if you survive the volatility along the way. The ultimate balance comes from accepting that you will never have perfect certainty. You act with the information you have. You size your exposure appropriately, and you remain ready to adjust when the facts change. The biggest mistakes often come from overconfidence, believing you can predict short-term moves, or from paralysis, where fear of loss prevents you from acting at all. The middle path is to be bold enough to participate, but cautious enough to stay solvent if things move against you. Silver today offers both a meaningful opportunity and a meaningful risk. Convergence of macro trends, structural shifts, and potential catalysts creates a setup that doesn't come around often, but it demands respect for the market, for its history, and for the unpredictability of human behavior when money is at stake. If you can navigate that with discipline, you put yourself in a position where over time the scales tip in your favor. And in markets that balance where the odds lean towards you without exposing you to ruin is as close to an edge as you can realistically